Have you noticed how some people work all their lives, put money away faithfully, yet still end up financially strained when they retire? The harsh reality is that many Americans over 60 unknowingly set themselves up for a tougher future by clinging to assets that look safe but quietly drain their wealth. Warren Buffett has been sounding the alarm about these traps for decades. His guidance couldn't be clearer. Stick to businesses that generate real profits, minimize costs to almost nothing, and steer clear of Wall Street's fancy, overpriced products. In this breakdown, I'll walk you through 10 specific assets Buffett warns are silently wrecking retirement dreams. Some may surprise you because they're often advertised as secure or conservative. But when you crunch the numbers, the story changes. If you're over 60 and hold any of these, rethinking them could be the most valuable financial move you make this year. Wealth Destroyer 1. Gold and non-productive assets. Let's begin with the sacred investment many people treat almost like a religion. Gold. Buffett's view is brutally straightforward. In his 2011 shareholder letter, he joked, "You can fondle the cube, but it won't respond." His real point was in the math. Imagine all the gold in the world, about 170,000 metric tons. If you melted it down, you'd have a cube roughly 68 feet on each side, valued around $9.6 trillion. Call that Pile A. Now imagine using the same $9.6 trillion for Pile B. You could own all U.S. farmland, 16 ExxonMobils, plus an extra $1 trillion in cash. 100 years later, the farmland would keep producing valuable crops, ExxonMobil would have paid out trillions in dividends, and those businesses would still hold assets. Meanwhile, the gold cube would look exactly the same, earning nothing. That's the lesson. If an asset doesn't generate income, it's hope, not cash flow, propping up your retirement. History proves the point. Over the past half-century, U.S. businesses represented by the S&P 500 have massively outperformed gold. They create profits, reinvest, and grow. Gold just sits there. I once spoke with a retired engineer from Detroit who kept 40% of his nest egg in gold coins. He thought he was playing it safe, but compared with a simple S&P 500 index fund, he'd lost out on nearly $300,000 in potential gains over 2 decades. And the tax side hurts too. Gold is taxed as a collectible, with gains facing rates up to 28% instead of the lower 15 to 20% long-term capital gains. If you want inflation protection, Treasury inflation, protected securities, or I-bonds do the job and still provide income. My personal rule, hold a little gold if it helps you sleep, but don't let a shiny, non-earning cube steal money from the assets that actually pay you. If you're finding this eye-opening, type gold trap in the comments. Wealth Destroyer 2. High-fee mutual funds. This next one drains retirements quietly but relentlessly. Mutual funds with high expense ratios. The SEC lays out the math. On a $100,000 investment, paying just 1% in fees compared with 0.25% could cost you nearly $30,000 over 20 years. That's an entire year of retirement living expenses gone. Morningstar's research shows one fact again and again. The expense ratio is the most reliable predictor of a fund's success. Lower costs win. But there's another trick buried inside. Share classes, front-end loads, 12B-1 distribution fees, and hidden charges funnel money away from you and into the fund company. I know a man from Ohio who discovered his so-called conservative retirement fund was draining 1.3% every year in layered fees, $1,300 annually on his $100,000 balance. Switching him into a low-cost S&P 500 index fund was like giving himself a permanent $125 monthly raise. Buffett's advice? For most people, put 90% into a very low-cost S&P 500 index fund and 10% into short-term treasuries. Use FINRA's Fund Analyzer tool and compare your funds. The savings over time will shock you. Wealth Destroyer 3. Long-term bonds. Bonds are supposed to be safe, right? Not always. For retirees, long-duration bonds can be some of the riskiest holdings in the portfolio. Here's the math. Duration measures how sensitive a bond is to interest rate changes. If your fund has a duration of 10, A 1% rise in rates means about a 10% price drop. So the safe part of your portfolio can suddenly lose 20% in a year, like many long bond funds did in 2022. Buffett has warned for years that over long horizons, diversified stocks can actually be safer than bonds because they grow. If you need stability and cash flow, don't load up on long bonds. Instead, match your bond maturities to when you'll actually need the money. A 1 to 5 year treasury ladder is a great option, ensuring something matures each year for spending needs. That way, you won't be forced to sell at a loss when rates spike. Wealth Destroyer 4. Timeshares and Vacation Clubs. Here's a money sink disguised as a dream. Timeshares. The problem isn't the vacation, it's the math. Maintenance fees rise every year, special assessments show up without warning, and the resale market is brutal. Average fees hit around $2,200 to $2,600 per interval in 2024, climbing nearly 8% from the year before. Even if you skip using it, the bill arrives like clockwork. Worse, when owners try to sell, scam artists swoop in with guaranteed buyers if you pay upfront fees. A couple from Texas told me they'd spent over $35,000 on fees and assessments beyond their original timeshare cost. When they finally tried to sell, they found similar units listed for pennies on the dollar. Buffett's principle applies. Rent the vacation spot you want when you want it. Keep your flexibility and avoid a lifetime of bills. If you're trying to exit a timeshare, start with the developer or owners association, explore deed-back programs, and only work with licensed brokers. Never pay up front for guaranteed sales. Put your travel money in a treasury-backed account earning over 4% instead. Wealth Destroyer 5. Concentrating in one stock. Another hidden danger is putting too much of your retirement in one single stock, especially your employer's. It feels safe because you know the company, but the data is brutal. More than half of all individual stocks underperform even risk-free treasury bills over the long run. Meanwhile, just 2 to 4% of companies drive almost all of the market's growth. If your portfolio leans too heavily on one ticker, you're gambling your retirement on beating those odds. Employer stock makes it even worse. If the business suffers, you can lose your paycheck and your portfolio at the same time. Just ask former employees of Enron or Lehman Brothers. Buffett's approach? Own the entire market through index funds and let winners and losers balance themselves. Limit single stock exposure to no more than 5 to 10%. If you're over that, sell gradually, say 10% each quarter, and reinvest into diversified funds. Wealth Destroyer 6. High-fee variable annuities. Annuities are marketed as security, but variable annuities are fee traps. You've got mortality and expense charges, administrative fees, underlying fund costs, plus pricey riders. Altogether, you may be paying 2 to 3% annually, plus surrender charges that can lock you in for a decade. Worst of all, if you bought one inside an IRA, you gain no extra tax benefits. Annuity income is taxed as regular income, not lower capital gains. If you truly need lifetime income, look at simpler immediate annuities and compare payouts. They're often better. Already own a variable annuity? Request a full fee breakdown and know your surrender dates. If costs are sky high, consider a 1035 exchange to a lower cost version, but watch out for new surrender periods. Buffett's rule fits here. Keep it simple, keep costs microscopic, and invest in assets that grow instead of drain. Wealth Destroyer 7. Idle cash earning nothing. Holding too much cash feels safe, but is actually an invisible tax. Average savings accounts pay around 0.6%, while 3-month treasury bills have been yielding above 4%. That gap is lost income. Buffett doesn't let Berkshire's cash sit idle either. He parks it in treasuries, not low-yield accounts. Here's a system. Keep 6 to 12 months of emergency savings in a high-yield FDIC-insured account. For money you won't need for 3 to 12 months, build a treasury bill ladder. Treasuries are exempt from state and local taxes, which is a huge perk in high-tax states. You can buy them at treasurydirect.gov or through your brokerage. This one adjustment could add thousands of dollars to your retirement income without stock market risk. Wealth Destroyer 8. Cash value life insurance. Whole life, universal life, and variable life policies are often pitched as wealth builders. But for many retirees, they're expensive storage vehicles that bleed value through fees, sales charges, surrender fees, mortality expenses, and fund costs. And there's a hidden tax trap. If you borrow against your policy and it lapses, the outstanding loan suddenly becomes taxable income. Retirees have been hit with surprise bills of $20,000 or more. If you need insurance, term life plus low-cost investing usually beats these policies. Already own one? Request an in-force illustration to see future costs, surrender schedules, and loan risks. If the original protection need is gone, compare surrendering versus doing a 1035 exchange into a simpler, cheaper policy. Ask yourself, am I paying for protection or pretending it's an investment? Most people over 60 are better off with alternatives. Wealth Destroyer 9, negative cash flow rentals. Rental property can be great if it pays you, but too many retirees are stuck writing monthly checks to keep rentals alive. Passive losses often can't offset other income, and repairs, vacancies, and rising insurance eat away returns. If your property doesn't generate positive cash flow after realistic reserves, it's a business that costs you money. Do a true cash flow analysis. Factor in 5 to 10% reserves, vacancies, management costs, and Schedule E deductions. If it still bleeds cash after a year or so, consider selling. You could use a 1031 exchange into a property that actually cash flows or sell outright and use the suspended losses to offset gains. Remember Buffett's rule: own businesses that generate income, not ones that bleed it. Wealth Destroyer 10, the oversized house. Finally, let's talk about the home. Downsizing is a tough subject because it's tied to comfort, memories, and identity. But oversized houses quietly drain retirement funds. Larger homes mean bigger property taxes, higher insurance, utilities, and upkeep. Insurance premiums alone averaged about $2,370 in 2024 and are climbing faster than inflation. Selling your primary home can also unlock huge tax advantages, up to $250,000 of gains tax-free for singles, or $500,000 for married couples. That's money you can reinvest into productive assets. Add up your home's total costs from last year: taxes, insurance, utilities, repairs. If it's forcing you to take larger retirement withdrawals, downsizing could strengthen your finances dramatically. Use freed-up equity for a treasury ladder and index funds, letting your money work for you instead of your roof. Pulling it together. Every one of these wealth destroyers has the same theme. They either don't produce enough value or they actively drain you. Buffett's strategy remains beautifully simple. Own productive businesses through low-cost funds, keep near-term money safe in treasuries, and avoid overpriced, complex products. Don't panic or sell everything tomorrow, but get honest about what's helping you versus hurting you. Pull out your latest statements tonight and circle the problem assets. Fix one at a time. Maybe start by moving idle cash to treasuries or swapping an expensive fund for a cheap index fund. Each small win compounds into a stronger retirement. So now I'll ask, how many of these wealth destroyers are in your portfolio right now? And which one shocked you most? Leave your thoughts in the comments, rate this video from 1 to 10, and tell me what surprised you. I read every comment and use your feedback to keep improving.